So hi everyone, today I'll talk about a topic that is, should we use derivatives to protect against black swans or tail risk? With the increasing risk and volatility coming ahead, we should definitely take a look at tail risk hedging strategies using derivatives. So to put it short, a tail risk is basically a low probability event that may occur in the markets. So it could be a trade war, politics, a natural disaster, a virus. So all the events that could hurt the economy. In the recent months, we saw how Universa Fund, which was founded by Black Swan author Nassim Taleb, returned an approximate 3,600% in March of 2020 because of their tail risk hedging strategy that they use with derivative instruments. On the other hand, we saw many investors manage to miss billions in opportunities. So there's CalPERS, there's Alberta Investment Management Company, AIMCO, that closed their hedge risk tailing program and lost billions of dollars because of that. As investors, we should ask ourselves if it's a good thing to invest in derivative instruments to serve as an insurance-like payoff and protection. Should we always adopt tail risk hedging strategies with derivative strategies for the portfolio management? Well, those are great questions that can be answered. In this video, I'll try to outline and analyze which credit derivatives and instruments could serve as a good hedge against black swans, risk, increased returns, and decreased volatility during periods of crisis. My main opinion, of course, is that portfolio and wealth managers should use these types of derivative instruments to counter the risk and to increase the portfolio returns in the long run. So the first strategy would be to utilize VIX futures as a portfolio protection, and this could increase returns as well. So futures could be a very good financial instrument to prevent the portfolio to significantly lose money. As we saw in theory, futures are standardized versions of forward contracts that are traded on derivative exchanges. Its characteristics are that they mainly have a delivery date, an underlying asset, and a size with units. So the VIX is basically a volatility index that was developed by the Chicago Board and Options Exchange. Indeed, this index is calculated by using the S&P 500 30-day weighted average on prices of its options. The VIX futures are essentially a futures contract based on this futures index. So VIX futures could serve as a great way to mitigate risk and improve overall returns. Several researchers and theories have suggested such. In fact, the main strategy would be to allocate 5% of the portfolio to buy VIX futures when the threshold of 30 is passed, and work similar to an insurance premium and payoff. So this would reduce risk and increase return. So we see here on the chart, that's the volatility index on the left-hand side. Once it reaches 30, it's at this moment that we should allocate 5% of the portfolio towards this futures. So we see here that it increases, definitely is more performant than other types of portfolio. And it increases returns, decreases volatility as well. The second derivative instrument that we could use to implement such a strategy would be to utilize credit default swaps. So as we saw in our class, credit default swaps are a type of credit derivative that provides insurance against the default of a company or a country. A good way to implement this strategy would be to look at the United States junk bond average yield market. And once it reaches a certain threshold, we should adjust the portfolio position to include credit default swaps on risky asset classes. So this would function similarly to an insurance payoff as the previous one, where premiums would have to be paid in a periodic payment to the bank until the CDS expires or until the company defaults. A great example of this would be the Bill Ackman trade in April 2020, where he turned $27 million into $2.6 billion in a credit default swap trade. It was made on the North Investment Grade Credit Default Swap Index. So Bill Ackman's position was supposed to last 5 years and had monthly payments of $27 million, which is the CDS spread as we saw in class. So by May, Bill Ackman pulled all of his, exited his scheme and pulled all of his money. And he cashed in a colossal sum of money. So a great way to implement this strategy would be to look at the US high yield corporate bond interest rate, as we see here on the left-hand side. And once it reaches a certain threshold, for example, 6%, let's say, So once it reaches 6%, at this point we should allocate at least a small portion of the portfolio into the CDS trades to protect the portfolio and serve as insurance. And we should pay the insurance with a monthly fee. Of course, we should cash in if ever the profit is substantial, like in April here, as we see. Another great famous CDS trade was actually Michael Burry back in 2005 to 2008. So Michael Burry CDS positioned from this time with multiple investment banks, so Deutsche Bank, Credit Suisse, and Goldman Sachs. Dr. Burry managed to make a colossal sum of money and return of 489% at the peak of the 2008 financial crisis. So of course, like I said, not all the portfolio position should be allocated to CDS trades. It should only be a small portion because it requires significant amount of liquidity and monthly premium. So only a small portion should be put aside and should be served and put as an insurance-like payoff. Finally, the third derivative that could be a great thing to do would be to take a look at put options as a protection against black swans. So put option, as we saw in class, gives its owner the right but not the obligation to sell a certain amount of the underlying asset at a certain price. So here the buyer has to pay a premium to the option seller to acquire the right. So if the spot price is higher than the strike price, then there's no point of exercising the option. So what's good about this is that the losses are limited. So they're limited to premium, and the initial premium is the cost of the option. So the American put option here would be a better investment instead of using the European because, well, it can be used at any time. So at any time we can cash the investment. So there's still a question that remains. So when is it a good timing? When is it risk worthy enough to do that? Is there a criteria that we could use? So there's many questions that still remains unanswered. However, put options can be utilized on S&P index or other ETFs that could be representative of the overall stock market. So if ever the market tumbles, if a certain portion of the portfolio is allocated to put options on indices, well, this could be a good protection against downfalls and could maybe increase returns in the short run. So in conclusion, I think that dynamic hedging using derivative instruments are a good way to significantly reduce risk, reduce volatility, and increase returns, and be a good protector against black swans.